Hi, everybody. I hope you're doing well. As we finish up 2022 and head into 2023, thought this might be a good time to talk over where we've come from in this last year and where I think we might be going in terms of our real estate market. So I've got three charts to go over with you, and here is the first one. First thing I want to talk about is our months of inventory. And as you can see, we kind of have a U-shaped chart. And back in January to April of this last year, our inventory was down as low as 0.2 months and was really under a half a month, which is really between 1 to 2 weeks of inventory. So if you're a buyer, there was hardly anything to choose from, and that's why we saw those crazy escalated prices on listings, because all the buyers would flock to one home, and then we get into those massive bidding wars that were going often hundreds of thousands over the list price. Well, as if you recall, back in April and May, the interest rates started going up to start to deal with the inflation. As you can see, as the rates went up, our inventory went up with it, and we seem to be kind of cresting around the 2 months of inventory. We'll see how that goes as we come into the new year. I've talked about this before, but if you look again in a real estate book, anything under 3 months of any market under 3 months of inventory is technically considered a seller's market. I think the reason why we're not seeing that right now, it's really functioning more as a buyer's market, is because of the extent of the interest rates. When I talk to my lender friends, they've gone up to as high as about the low sevens, and now they have gone down to about the low sixes right now, give or take. So there's been a little bit of relief in terms of the interest rates. They are projecting that the rates in the first quarter could go down into the fives. We'll see if that happens or not. But right now, if I go on to the next chart, our median sales price, so how are the rates affecting our prices, basically? So if we look at the chart, back in April and May of this last year, and all these charts, by the way, are based on houses in King County. That's our subject matter that I'm pulling from. So back in April and May, in King County, the median home price crested at about $1 million. And remember, the median price is the price that's right smack dab in the middle, basically meaning that half the prices in King County were lower than $1 million, and half the homes that sold were above $1 million. So again, our median price crested at about $1 million, and over the next few months, as you can see, generally it's trended down to where at the end of November it landed at this point at $830,000 for the median price. So it's already come down about 17%, which I think honestly is just kind of a natural reaction to the rates going up, and the market's going to adjust to that. And so as we see it, it has to a certain extent. So we go into the next and last chart. The active versus pending chart basically is an indicator of supply and demand. And if you look at all these squiggly lines, the blue line is, those are the active homes for sale. So homes that are on the market but nobody's made an offer on yet. And the green line are pending homes for sale. So those are the ones that are under contract. They did get an offer and did accept it, but they haven't yet closed. So what we're trying to see is how quickly are those active homes going off the market, basically, and being kind of absorbed by the buyer demand. Well, again, back in January, February, March, and April, you see this blue line is a fair amount beneath the pending. So there were quite a few more buyers out there than there was inventory. Thus, again, we saw all the bidding wars. As the rates went up, well, then all of a sudden the actives and homes are starting to sit on the market a little longer. And so our inventory, or the active homes, are going up, just like we saw in the first chart. And but our pending started to go down. We go up to the end of November, while the inventory has come down some because we're in our winter months. There are fewer people putting their homes on the market right now. We also see that the buyers are probably paying more attention to Christmas and Thanksgiving and stuff than they are. A lot of them have decided to kind of wait until the new year. So speaking of the new year, if I go back to actually on this chart, I anticipate in the new year that especially, well, even if the rates stay about where they're at, usually homes start coming on the market in the springtime. So somewhere between January to March, people start thinking it's probably a good time to sell. And buyers are no longer focused on the holidays anymore, and often are thinking, well, maybe we need to get into a home before the next school year starts, etc. So the buyers tend to come out as well. So my guess is both of those lines, to a certain extent, are going to start going up again. If you're a buyer and you've been waiting for the rates to get better, or you're afraid the market's going to crash, etc., if you want to be able to get an inspection when you make an offer on a home, and you want to have a contingency for that, and you would also like a financing contingency and all the normal contingencies that would be there, this might be your window. If the rates continue to go down, and especially if they go down, in my mind, I'm thinking if they go down to the lower 5s or 4s, more than likely we're going to start seeing these lines start to flip-flop again, and we may very well become a seller's market again and start seeing bidding wars. And I don't know if we're ever going to go down to the interest rates being in the like 2s and 3s. Time will tell, unless the government artificially, starts buying back mortgages and all that kind of stuff again, which they could, but barring another shock to our economy, right now I haven't heard any plans of that. But I do think, again, if we head down into the especially low 5s or into the 4s, I think that more buyers are going to jump back into the market because their bang for their buck has gone up and they can afford more house. And people want to lock in that lower interest rate. So there's a saying in the industry where often the recommendation is you marry the house and you date the interest rate, being that when you buy the house, you're committed to it for a period of time because it's obviously a large financial investment. And but the rates if the rates did go down later, you could refinance and get a new rate later on, kind of break up with your old one, so to speak. Anyways, if you have any questions about this, by all means, give me a call. I would love to talk about your specific situation and see what might make the most sense for you. And if you know anybody looking to buy or sell or invest in real estate, I'd be honored if you would be willing to introduce us so I can talk and see if I might be able to help them. So thanks a lot, and I wish you a very Merry Christmas and New Year's and such. And hopefully we can talk soon. Thanks a lot. Bye-bye.